Let us see how to calculate the profit or loss. I request all of you to pay attention. Column number 1, particulars. Column number 2, amount. If at all we sell goods to the customer, sales will increase by 1 lakh. If at all we sell goods to this customer, production and selling expenses will be 80,000. That is 1 lakh into 80%. Chances of bad debts are provided to us. It is 10%. That comes to rupees 10,000. Both expenses will be deducted from the revenue to make the calculation of profit before taxes. That is PBT. It is an amount of 10,000. Now question is providing that so the income tax rate is 40%. So you have to pay tax at the rate of 40%. 10,000 into 40%, that is 4,000. Next is profit after taxes. That is P18. It is an amount of 6,000. That is the way the PAT can be calculated. Now the most important point of the question starts. See, adopting incremental approach is mandatory. Bifurcation of the total cost into variable and fixed are not possible. Those are not so important. But now the important point of the question starts. And it is like this. The question is providing the information that says this customer requires 1.5 month credit. Offering 1.5 months credit to the customer will require the investment of 10,000 rupees from our side. So we understand that say if at all we sell goods to this customer, we have to invest an amount of rupees 10,000. Instead of selling goods to this customer, if I would have invested the fund somewhere else, then in that case, what I would have earned, the question says like this, you will have some amount of the profit before taxes. From that you will pay tax, and afterwards you will earn some amount PBT. From that say you will pay tax, and then you will have the profit after taxes. How much? 2,500. Yes. The question is providing the information that say this opportunity cost of capital of 25% is on post-tax basis. It is on after-tax basis, like that information is given. Means you will earn something, you will pay tax on it. Afterwards, your net earning will be 25% of the investment that say you make. Okay. So this is what's the opportunity cost given to us on after-tax basis. That is the reason say what we will do, friends. We are required to deduct the carrying cost at this point of time. We will deduct the carrying cost. What is the carrying cost? 2,500. So from 6,000 rupees, we will deduct 2,500. And we will be having, say, the net profit. Net profit is 3,500. See what happens, let's say we understand that say if at all we sell goods to this customer, we have the profit after taxes of 6,000 rupees, and 6,000 rupees of the profit is more than rupees 2,500 of the opportunity cost. That is the reason we should sell goods to this customer. This is what we understand. Please write on, please write down answer. Now one more point. See, the answer is over, but still I am explaining one more point. The question may provide that the cost of capital is before tax. Like that information may be given. In that case, what will happen? Let us understand. In that case, what happens at say, from this 10,000 rupees of the profit before taxes, we are required to deduct the carrying cost. How much? 2,500. This is the way we are required to do answer. Why? Because the cost of capital is given pre-tax. Pre-tax cost of capital means before you make the payment of tax, you could have earned 2,500. And over here, by selling goods to this customer, again you are able to make an amount of profit of 10,000 before making payment of tax. 10,000 is greater than 2,500. So we should sell goods to the customer. That is what we understand. So whenever the income tax information is given, you have to see whether the cost of capital is pre-tax or post-tax. If it is pre-tax, then in that case the carrying cost will be deducted from profit before taxes. And if it is post-tax, you have to deduct the carrying cost from profit after taxes. That is the difference that we have. Let us answer the question. The company is advised to sell goods to this customer. That is a simple answer. Further, whenever income tax rate information have been given, comma, we understand that when to deduct carrying cost is very important. Underline the word when. Cost of capital, in bracket write down K, one of the two information will be there, pre-tax, or it is given a name as before tax. Post-tax, or it is given a name as after tax. If it is pre-tax or before tax, then in that case we understand deduct carrying cost from PBT. in a way that's a before calculation of tax. And on this side, deduct carrying cost from PAT. It is required to be deducted in both the cases, but when to deduct is important. Second part of the question, also find degree of risk of non-payment that the company should be willing to assume if required rate of return after tax by 30%. That is the question. I want you to do that is second part of the question on your own and put your answer in the chat box. But before that, a small explanation. Sometimes what happens is the students are like very creative students. They have uh, a kind of argument like this. So the profit after taxes is 6,000. Yes. Amount of investment is 10,000. Yes. So sir, is it fine if at all I make the calculation like this? On selling goods to the customer, actual return is 6,000 divided by 10,000 into 100. Actual return is 60%. And the required rate of return is given to us in the question 30%. So actual return is exceeding the required rate of return. So we understand that say we can take a decision like this. Sell goods to customer. This is also a valid answer. You compute that say what is the return that say you are able to get on selling goods to the customer. It is profit upon investment into 100, that is 60%, which is greater than, which is more than 30% required rate of return of the investor. That is company over here. So we should sell goods to the customer. So just for understanding. Now I want you to tell me answer for the second part of the question in the chat box. I request all of you to pay attention to me. That is, say, pay attention over here. I request you to give answer for the questions which I am asking. In the second part of the question, are we supposed to take any decision? In second part of the question, are we supposed to take any decision the way we have taken decision in the first part of the question? In second part of the question, we don't have to take any decision. So in second part of the question, there is no need of making calculation of the carrying cost, because carrying cost is calculated just to take a decision. But in this case, so there is no decision to be taken. In second part of the question, what is required to be calculated by us? We are required to find degree of risk of non-payment. Degree of risk of non-payment. What does it mean? Percentage of the bad debts. Or we understand let's say the chances of bad debts which the company is willing to take, which the company is ready to take for a discounting rate of 20%. If at all they want a return of 30%, for discounting rate of 30%, it means that say for getting a return at the rate of 30%. That is what they have provided. Means in the second part of the question, we are required to give the answer in terms of the bad debts. We don't have to compute the profit. Rather, profit is given to us in the question. Yes. What they have specified. What are the chances of the bad debts that you can afford so that you get a return at the rate of 30%. Return at the rate of 30% means you have invested 10,000. So 30% of 10,000 is 3,000. Yes. You desire a profit of rupees 3,000 on after tax basis, and for this profit, what are the chances of bad debts that you can afford is the question. So we have to work out the answer like this. We start with the revenue sales. Sales is given to us in the question, an amount of 1 lakh. Then production and selling expenses. It is an amount of 80,000. It is 1 lakh into 80 percentage. Minus bed debts. Do we know bed debts? No, that is the final answer. So I keep that blank. Then I'm writing profit before taxes. Since we do not have the bed debts, we do not have the profit before taxes. Since we do not have PBT, we do not have tax at the rate of 40%. Then profit after taxes. Do we have profit after taxes? Yes, we have profit after taxes. We are making investment of 10,000. So from where have you got 10,000? See, in the first part of the question, we already have found this is the investment. We are investing an amount of 10,000. This is the investment. Into cost of capital is 30%. So we require the profit of rupees 3,000 from the business. We require the profit of 3,000 by selling goods to the customer. If at all I want a profit of rupees 3,000, then what should be my profit before taxes? For that, say the simple equation is like this. PBT and PAT. For every 100 rupees that you earn, 40 rupees is tax, and your profit after taxes is 60 rupees. Your profit after taxes is 3,000. Okay, the calculation that I have made. So your PBT will be how much? It is 3,000 into 100 divided by 60. So your profit before taxes should be 5,000. So this is 5,000. That is 3,000 into 100 divided by 60. Why? Because the tax rate is 40. Now income tax is very simple to find. 5,000 into 40%. That comes to 2,000. Now understand that, say, from sales of 1 lakh, 80,000 is the production and selling expenses. So you have 1 lakh minus 80,000. You have profit of 20,000 right now. After deducting the bed debts, your PBT should be at least 5,000. So what is the amount of the bed debts that you can afford? 15,000. So we understand that, say, for every 1 lakh rupee of the sales, amount of the bed debts that you can afford is 15,000. So percentage of the bed debts that you can afford is 15,000 divided by 1 lakh into 100. So it comes to 15%. So 15% is the maximum chances of bed debts that we can afford. In that case, we will be getting a return exactly at the rate of 25%. This is the way we are supposed to make the calculation of answer. So the amount of the bed debts is calculated as balancing figure like this. So this is the way we are required to do second part of the question. I request you to write down answer. Write down further answer. This is only for, that is first of all one line answer, and then I dictate to you a note for this. In order to get a return of 15%, sorry, of 30%, comma, company can afford maximum bed debts of 15 percentage. Full stop. With paragraph read down. In second part of the question, we have to compute what are the chances of bad debts that company can afford so that company can get 30% return. Full stop. Further in that write down, importantly, no decision is required to be taken comma, so carrying cost is not calculated. Full stop. So small summary of the answer. The question is providing information that say we are considering to sell goods to a group of new customers with 10% chances of bad debts. Collection period is provided 1.5 months. By selling goods to that customer, sales will increase by 1 lakh. Production and selling expenses are 80% of the revenue. And the important information is the income tax rate is provided to us. Discounting rate is given. In that say, importantly it is given on after tax basis. So since existing sales is not given, method number 1 is not possible. By selling goods to this customer, sales will increase. So method number 3 is not possible. Only second method is possible. We cannot bifurcate the total cost into variable and fixed cost. That's okay. So the total cost is calculated by selling goods to the customer. The second is calculation of the carrying cost. This time, since I had to give an explanation from the investment point of view, so I split the working in detail. What is the investment that say we make when we sell goods to the customer, and that amount could have been invested somewhere else. So in detail I explained the carrying cost calculation. Next is simple calculation of the profit or loss on selling goods to the customer. Sales will increase. Production and selling expenses, bad debts chances 10%, PBT minus tax PAT. Importantly, the cost of capital is on after tax basis. So carrying cost is deducted from PAT. That is the way the net profit is found. So the company is advised to sell goods to the customer. I tried to give explanation of the same question with an alternative method wherein we compute the actual return 60%, which is more than required rate of return 30%. Cost of capital is given before tax, then deduct the carrying cost from PBT. After tax, deduct the carrying cost from PAT. Second part of the question, again important over here, wherein we are required to compute the bad debts. So it is found as balancing figure. Make some arrows like this that will help you to, and that is recall the things in your revision. So we computed the PAT based on the investment and required rate of return. Then we made the backward working. Finally, the percentage of the bad debts is found, and based on that, say we take the decision. That is based on that, say we just give the answer. No decision is required to be taken. This is the way we do answer.